Are you concerned about the market movements from October 21 till April and May 2022 falling down? Are you concerned about your investments in mutual funds and don't know where to ask and what to do? If you're looking for such solution, then this video is for you. Hi, I'm Taresh Bhatia. I am a certified financial planner pro by qualification. I'm the principal officer in a SEBI, Securities Exchange Board of India, registered investment advisor called as RIA. And I am a financial freedom specialist helping thousands of individuals and families to overcome their fears about money and plan their finances in a way that everything comes to them whenever they need the money for their own goals. I've written this book, The Richness Principles, in 2015 to 2019 and now an Amazon bestseller. The Richness Principle is a guide, is a mentor, is an opening for you to understand how your money can work better based on certain principles, strategies, tactics, and gives you an action plan. Well, that's what you should be having. Certain principles on how your money should be working, how your investments should be going, and then somebody gives you the right strategies, that this is the strategy in this down market, this is the strategy in this up market. And then you have a tactic that, okay, do this with this kind of category of mutual funds. And finally, an action plan to invest, because you just can't observe and do nothing. Now, what should be done? I've put together 11 ideas, 11 strategies, 11 backgrounds, you can say, for you to understand, to help you understand how things are moving and what you should be doing and what is the best way to keep calm or quit or enter or exit. So let's go deep dive. But before I continue, please subscribe to my YouTube channel, Taresh Bhatia, and do share and like this video if you have liked it. Put in the comments below if you liked my ideas and if you like me to continue with such ideas going further. So without any delay, let me go deep dive into those ideas. So 11 ideas is what I'm going to present here, and you are going to be looking at the finest ideas non-stop in the next few minutes. Do watch till the end, because at the end you get my recommendations, what my core idea is. That's at the end, number 11. So let's start with number 1. Number 1 is that optimism globally is quite low, obviously, because equity markets have fallen, debt markets have fallen across the globe in the last 2-3 months. Across the globe, every country is affected, and the biggest barometer of the US stock market, US S&P 500, is down since 1974. Imagine 40 years it's down, and the global markets are also plunged in the last 2-3 months. And in that, you want to understand what's happening, and therefore I would say that these global factors, which is coupled with a decade, once in a decade happening, 50 years back it happened, that inflation is the highest in US, and that leads to a liquidity crunch, leading to interest rates moving up and equities going for better, faring to be better globally going forward. And that will have an cascading effect, not just on one or two factors, but it will have an impact on the global economies also, because inflation has taken an increase across the board, across the country. Recession therefore starts, liquidity comes down, the valuations of various companies obviously gets corrected, and emerging markets meanwhile are going upwards better than the developed countries. Now this is moving towards a positive sign. If this is a positive sign, is there something happening better in the Indian economy? That I am so confident that with tax collections of $27 trillion in the financial year 22, exports being $670 billion, GST and fast tax having such great collections, I think that Indian economy is still on the positive side despite all this. And despite the pandemic, has India moved forward? Yes, it has, because its economy has moved up by a percentage point and now stands at 6%. The globally, the share index from 2.6, it's moved down to 3.2%. And therefore, you can say amongst the BRICS countries, which is Brazil, China, South Africa, India, these countries, the Indian parameter goes up. And therefore, this has happened because of the government policies. And you can say the government of India has supported in the last 2 years, 5 years, in terms of 5 factors. And those 5 factors are production linked incentives for the corporates, PSU bank consolidation happening, GST, land reforms, and Make in India becoming a much better option and being one of the top strategies going forward. Now, why am I confident about the Indian sectoral indices, which did much better than they did in 2022? Now, this could be also a reason that I'm confident, because 5 industries have done so good in the last 2 years despite the pandemic: power, oil, infrastructure, FMCG, auto, and energy. Now, with this, the 6 areas, if the sectoral indices have performed very good, then it gives me the confidence that the equity outlook could be good or okay. But I would say, if I bring up the parameters here, I would say that medium to long term is what I would say. Yes, I'm positive, but near term, I would say to be cautious. Now, why is this so? Because in the medium to long term, there is a strong domestic capex. There is favorable demographics. Now, what do I mean by demographics? Now, demographics means that the average Indian population is between 18 to 25, 25 to 35 is increasing. In the US, it is the opposite. The plus 60 is increasing. Therefore, the consumption, the earning capacity, and what we produce within India also is increasing. What we produce is consumed. Because of this young population, the earning capacity of a family is also high. And this is a factor of increasing number till 2050, as the statistics show. With this, if I am positive, then government reforms have also given us positive indications. Now, multipolar markets is where India is now operating. Now, Modi decided, I guess, in 2015, 14, 15, 16, that to spread out just for a couple of countries, export and import, spread it across to 50 countries, so that we're not just dependent on 1 or 2 countries, but the risk is divided across 50, 60 countries. And that means that we do not depend on a sneeze in one country and we catch the cold. We are not kind of dependent now. The market cap to the GDP ratio has increased. At touching the global indexes of 124, we have touched 102. So that's increased. But why would I say that continue in equities? Well, at the moment in May month, on 12th of May 2020, the Nifty PE index is at 19.4 as of today. Now, with this indication, I get, as a financial planner, investment advisor, an idea to continue in equity or to exit equity, into invest lump sum in equity or not. And little later at the end, I'll explain that also, whether I'm confident or not to continue in the end. So continue watching till the end. Now, I would say in the near term, be cautious, because with the slowdown in the global growth, this is leading to a monetary tightening across the world, across the country. So you have to be cautious in the next 3 months, 6 months, 1 year, not to invest lump sums in equity, with a goal to redeem it within 6 months to 1 year. So that I mean cautious. But in the medium to long run, I've said, yes, you can be confident to investing in equity mutual funds. Now, with that, a positive outlook on the equity mutual funds, what can be the other positives one can look forward to? If I would say that one has to look at a couple of factors. So the other positives could be that, we are expecting a near normal monsoon this year. India's resilience to the ongoing war has been seen to be very high, and India's capacity to utilization stands at 72% as of today, and the annual spending spree of an average Indian, after the necessities comes the spending power. Now, that is where Indians are spending at a level of 24% on average salary, increasing upwards the next 8 years till 2030 to 40%, which means whatever we are going to produce, whether it's soaps, whether it's footwear, whether it's clothes, whether it's utensil, whether it's power, whether it's energy, whether it's mobiles, whether it is laptops, whether it is anything which you consume on a day-to-day basis, automobiles, two-wheelers, three-wheelers, cars are going to be consumed. So the average spending, eating out, dining out, credit card spending is going to be increasing. So that makes it a positive environment for me to be confident that this is something much better than what you have seen or may see. Meanwhile, the other factors to watch out could be what you have to observe and with your financial planner, that are the crude oil prices still increasing? Geopolitical risk, that is the Russia-Ukraine war, India-China, any conflict happening, any kind of China-Taiwan or any other geopolitical factor going to be affecting the Indian economy. And finally, inflation. Yes, it is at 6.7% today in India, but if inflation is going to be rising, then liquidity is going to be becoming an issue, and that will lead to rising interest rates and will have an impact on the valuations of various companies, and that will have an effect on the equity markets while you are invested in your equity mutual funds. Now, if these are the couple of factors to keep in mind, can I say with confidence that one can be positive on the equity market, or can I say that one has to be cautious? Let's take a look. Well, I would say that in the last 2 odd years of the pandemic and the results which have come out, small cap and mid cap mutual funds have outperformed, and there has been FPI outflows happening, in the last couple of months, especially March and April and now May. But the domestic investors are buying into the Indian mutual funds. Like you see, October 21 till April 22, the outflows have been there, and the Nifty has also come down to minus 8%. But the mutual fund inflows today have increased in the same period by 1,40,000 crores. So that means people are still confident of the Indian mutual fund industry in the market, and they are continuing to investing. So if you're making a mistake, think about it. And finally, this is one of the barometers which gives me an indication as a financial planner. Now, if you look at very clearly, it's a very simple equity valuation index, which tells me that so April 22, which is the latest chart I have received, indicates 117.2.7 as a valuation index. It's in the orange. The bar is touching the orange. If it goes to red, then I should be booking profits, which means I should be exiting equity market, I should book profits because it's overvalued. And if it is undervalued, which means that if this index goes to green, and if it goes to dark green, then it clearly gives me an indication that I should be investing in equities and aggressively investing in equities. Now, this is the topmost secret. As a common layman, what you have to understand that this is where we stand today, and therefore it is still a positive environment if, as I said in the beginning itself, let's go back to the beginning. The first part I said that when there is optimism and equities have fallen and debt markets across the world are not so great, then is it a positive or a negative? Then I have talked about that inflation high and global, these factors are affecting. I've also said that these are the factors which are going to be affecting. Therefore, with this, I would like to summarize now that if the Indian economy, as you have seen, is so positive, and what should one be doing now? The sectoral index have shown good. Equity markets in the long run have shown good. And this is where I talked about the Nifty PE being at 19.4. So with this, you can be confident that if this is showing here and that valuation index is indicating staying invested because it's 19 times the valuation. So if it is at this levels, it means that you can confidently continue to stay in equity mutual funds based on a lot of other parameters which your financial planner must have told you. And finally, let me put in my recommendations, because I promise you to watch till the end, because this is what my recommendations come up. Number one, watch the Sensex and Nifty with care, because there is still a bottom possibly happening in August, and therefore you can call it a deep blue market correction, a deep bull market correction. So yes, I'm confidently saying it, the markets are going to still slide down. Your equity mutual funds may see 2 to 4% as of today and may go down to -10, -20. But that's where you are on a roller coaster ride. You're not here only for the upward movements, because even the heart beats like this. So, with this uncertainty, why is this so? Why I'm saying so? Because uncertainty as of today, due to the geopolitical tensions, due to the crude oil prices, due to the inflationary trends globally, and the supply chain being tightened across the world, manufacturing industries are getting affected. But I would recommend equity investing. Why? Am I? No, I'm neutral towards equities at the moment because markets are volatile in the near term. As I said earlier, the next 3, 6 months, 1 year. Don't expect to be investing lump sum, not my recommendations, and also expecting to redeem within 3 months, 6 months in the next 1 year. Therefore, I said neutral to equities for those people. Now, I would recommend equity mutual fund with a long-term perspective where your asset allocation is in place, and there are, if you have a 2 year or a 3 year or less than 3 year goal, then asset allocation schemes become a very good alternative. That's my recommendation for you. Next, I would say is that uh, gold has now become an attractive asset class. Yes, it has, because obviously when inflation is going up, global environment is tightening up, and there is geopolitical tensions happening, and when there is war, what do? What do you run away with? Gold. You can only run with gold. You can't run with mutual fund statements or with property statements or with your bank account statement. You can run with gold to another country. And therefore, I would say confidently, as of today, last 10 years has been a conducive environment because of equities and the bonds. But the rate cuts, the fiscal stimulus which we have seen, and the geopolitical tensions, and the coming decade, gold is going to be a lucrative option. So put together, I would say 10 to 20% of your total investment portfolio into gold mutual fund scheme. I'm not even saying physical gold because there are charges and there is deduction on that amount. So as an investor, this is a good idea for my clients to be investing in gold up to 10 to 20% of the overall portfolio. So if that is not there, well, speak to me and get it done. For those who are still looking for understanding where to park their emergency fund or contingency fund, well, fixed income outlook is looking little better because of the opening up, the interest rates increasing in the next 1 year, 6 months to 1 year. Three funds is what I would recommend as categories: gilt funds, floating interest rate funds, and savings fund. Do understand the exit clause and the 1 day it takes T+1, it is called, for the money to come into your bank account, and it is part of your overall financial plan. And on the other side, I would also say avoid IPOs if you are having a strategic allocation and you have tactics with you and your financial planner is now advising you. Don't go for IPOs at this moment. Not having asset allocation, not do not look at past performances, because we go deep into so many other factors when we recommend mutual funds, and I can, there's a separate video I've made for that. Watch in the YouTube links. I would say don't react to temporary ups and downs, because they are, as I explained, it's a roller coaster ride. And with active management, you do have a strategy in place. Having no financial plan and or not following it also creates panic amongst in your mind that with this market going up down, where do I look at my, how do I look at my investments? And finally, having no assistance or not understanding what your investment advisor is recommending the strategies and asking you to take an action on the action plan with the investment advisor. In our case, indirect online mutual funds for our clients, transaction assistance is done by us based on the goals, time horizon, risk profile. So understand the three factors also. Don't take my recommendations from this video, because my disclaimer: mutual funds are subject to market risk. Read all scheme related documents. This information is purely for understanding and education purposes. It nowhere means that you should be going with this advice, investing, exiting, entering, or taking any such decisions before you consult your financial planner, investment advisor, your legal consultant, your tax consultants. And this video is only for the purpose of education. And if you understood, you liked this video, Please put in the comments below how you liked the video, and if you would like me to put in more videos like this, what would you say should be the topics which you want me to cover, so that I can bring in more topics and I can be with you on much more. Meanwhile, if you haven't subscribed, liked, comment, please go ahead and do that on this YouTube channel if you're watching on YouTube. Thank you very much. This is Taresh, your financial freedom specialist, just to bring certain ideas and to help you not to panic and this environment in 2022 May. And going forward, this was the outlook for the month of May. And I hope and I trust you like this video. Thank you very much.